Two investors entered the crypto market at the same time. One became a trader. Every morning began with charts, alerts, candlesticks, market sentiment, influencer tweets, fear, greed, entries, exits, stop losses, false breakouts, sudden dumps, unexpected pumps. His phone never slept, and neither did his mind. Some days he won. Many days he thought he won until the market changed direction. The second investor chose mining. Not because it looked exciting or promised overnight riches, but because he understood something many people in markets never learn. Serious wealth is rarely built by chasing movement. It is built by owning systems that produce value over time. The trader spent his days trying to predict what thousands of strangers would do next. Would they buy? Would they sell? Would the whales dump? Would the bots front run? Would the breakout hold? His success depended on being right again and again in a game where speed often beats intelligence. The miner asked a different question. How do I accumulate more assets while others are distracted by noise? That single mindset shift changed everything. When markets went up, the trader felt pressure to chase momentum. The miner kept accumulating. When markets went down, the trader felt fear. The miner kept accumulating. When the market moved sideways for weeks, the trader became frustrated. The miner. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Kept accumulating, because mining changes your relationship with the market. Trading forces you to focus on price. Mining allows you to focus on ownership. A trader constantly worries about timing. A miner benefits from time. This is how serious investors think. Look at traditional wealth. Real estate investors don't wake up every hour trying to predict the next price swing. They build, they hold, they accumulate. The same principle applies in crypto. Mining is a form of accumulation, not speculation. It's a system that produces value over time, regardless of market volatility. The trader's success is tied to market conditions. The miner's success is tied to his ability to maintain and scale infrastructure. Mining is not a get-rich-quick scheme. It's a long-term strategy that requires patience, capital, and operational discipline. It's not about reacting to price changes. It's about generating value through consistent output. The miner's focus is on equipment, energy costs, network difficulty, and hash rate. These are the variables that determine mining profitability. The trader's focus is on sentiment, volume, and candlestick patterns. These are the variables that determine short-term price action. One is a producer of value. The other is a participant in speculation. Mining offers a different kind of risk profile. It's not immune to market downturns, but it's less affected by them. A miner's output is not determined by what others are doing. It's determined by how efficiently they can produce blocks. A trader's output is determined by how well they can predict what others will do. This distinction is important for investors who want to build lasting wealth in crypto. Mining allows them to focus on the fundamentals of the asset they're holding, rather than the whims of the market. It's a strategy that rewards time, not timing. The miner accumulates assets regardless of market conditions. The trader accumulates assets only when the market is moving in their favor. Mining is a system that produces value even when the market is quiet. Trading is. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. A game that produces value only when the market is active. This is why mining is a better choice for serious investors. It's a long-term strategy that doesn't rely on constant vigilance or market timing. It's a system that builds wealth through consistent output and asset accumulation. It's not about chasing movement. It's about owning systems that produce value over time. The next signal to watch is how mining profitability holds up during extended market volatility. If miners continue to accumulate assets while traders are forced to liquidate, it could signal a shift in investor sentiment toward long-term value creation. That's the kind of signal that serious investors pay attention to.